The Dow just tumbled 800 points.
Wow.
Yeah. The S&P 500 is on its longest losing streak since the turmoil of 2022. And fertilizer prices are up a staggering 89%.
That's just an incredible number.
It is. Okay, let's unpack this. What is actually happening here?
Well, it is a profound structural realignment. And, to understand the plumbing of this massive sell-off, we really have to look straight at the geopolitical catalyst.
Right, the month-old Iran-U.S. conflict.
Exactly. We are looking at a strategic disruption of the Strait of Hormuz by Iranian forces, coupled with direct retaliatory strikes on energy infrastructure.
I want to stop right there and look at the actual mechanics of that disruption because, the Strait of Hormuz gets thrown around a lot in the financial media.
Oh, constantly.
But it's not just a shipping lane. It's the single most critical arterial vein for global liquid energy.
It absolutely is. Because of the current blockade and the infrastructure strikes, roughly 8 million barrels of oil per day are suddenly offline.
8 million, that's huge.
It's a historic, instantaneous supply shock. The global supply chain operates on just-in-time delivery.
Right.
So when 8 million barrels just vanish, refineries can't produce diesel, ships can't move goods, and aviation fuel skyrockets.
And it completely destroys the market narrative.
Exactly. It takes the market's core assumption over the last 6 months, the idea that structural inflation was dead and the Federal Reserve was going to aggressively cut rates, and violently dismantles it.
Which perfectly explains the absolute whiplash we saw on the trading floor this week.
Oh, the volatility was insane.
Let's walk through this timeline. Monday, March 23rd was an incredible fake out.
Yeah.
The S&P 500 jumped 1.1%, and the small cap Russell 2000 leaped 2.3%.
Yeah, everyone was breathing a sigh of relief.
Right. The market was aggressively buying the dip because of President Trump's comments suggesting a 10-day pause in hostilities and potential ceasefire talks.
But that rally was built on algorithmic sand.
What do you mean by that?
Well, the reality of modern quantitative trading is that algorithms scrape headlines and buy the rumor in milliseconds. They see ceasefire and they just buy.
So there's no actual human analysis happening there.
Right. But by Tuesday, human discretionary traders looked at the actual physical realities on the ground. The ceasefire hope faded completely.
And then came the ultimatum.
Exactly. By Friday, Trump issued an April 6th deadline, basically an ultimatum for strikes on Iranian power plants.
And the market vomited. The S&P 500 closed the week down nearly 1.9%, and the Nasdaq dropped 2.1%.
Tumbling right back into correction territory.
But the geopolitical tension is only half the equation here. The other half is the Federal Reserve.
The Fed is in a really tough spot.
Yeah, let's dig into that March 18th FOMC meeting. They held rates steady at 3.5 to 3.75%.
Right, the classic hawkish hold. But the real story wasn't the rate decision itself.
It was the projections, right?
Yes, it was the plumbing of their economic projections. The Fed officially upgraded their 2026 PCE inflation forecast to 2.7%.
Wait, hold on. The market was completely priced for multiple rate cuts this year.
Completely.
If they are raising their inflation forecast to 2.7%, which is, well above their 2% target, what happens to the dot plot?
The dot plot gets flattened. The futures market went from pricing in 3 or 4 cuts to pricing in expectations of maybe 1 cut in 2026 or possibly 0.
Wow, 0 cuts.
Yeah. And the broader economic fallout is what the OECD just modeled in their latest GRIM report.
Oh, I saw that. It's not pretty.
No, it's not. They are projecting U.S. inflation is going to hit 4.2% this year. That is the highest in the entire G7.
And because that kind of inflation acts as a massive tax on corporate margins and consumer spending, they've downgraded U.S. GDP growth to just 2.0%.
It's the textbook definition of stagflation.
It reminds me of the narrative we've been fed for the last year. The market was totally sold on this soft landing idea.
Oh, totally.
It's like we were on a plane, the landing gear was down, we were on final approach, and suddenly the runway is covered in crude oil. The pilots pull back on the yoke, alarms are blaring, and we are forced into a violent emergency pull-up.
The soft landing has absolutely been aborted. We are back in the clouds, and visibility is 0. The Fed can't cut rates to stimulate that 2.0% growth, because if they do, they risk pouring gasoline on the 4.2% inflation fire. Their hands are completely tied by the energy market.
This rotation, this exact market dynamic is why we do these deep dives every week.
Exactly.
So to you listening, since these market narratives are literally shifting by the hour from Monday's fake-out rally to Friday's heavy sell-off, Make sure you subscribe, like, or comment on our YouTube channel.
It really makes a difference.
It does. It's the best way to ensure the algorithm keeps serving you these timely deep dives so you don't get caught off guard by the next macro shock.
Highly recommend it.
Now, as bad as the macro index picture is, here's where it gets really interesting. Beneath the surface, it isn't just a blind panic sell-off. We are seeing a brutal rotation.
Yeah, capital's moving fast.
We are watching specific companies make monumental history-making moves that operate completely independently of the Fed or oil. Let's look at the tech reckoning.
Oh, the legal earthquake.
Right. Specifically, the legal earthquake that hit Meta and Alphabet on Wednesday, March 25th.
This is a landmark jury verdict out of Los Angeles.
Yeah, a 20-year-old plaintiff won $3 million in compensatory damages.
And the jury found Meta 70% responsible and YouTube 30% responsible for her severe mental health distress during her teenage years.
Okay, I have to push back here because, $3 million to Meta is literally a rounding error.
Oh, they make that in minutes.
Exactly. It's what they make in a few minutes of ad revenue. Why is the market treating this as an existential threat?
Because it's not about the dollar amount, it's about the legal mechanism.
What do you mean?
Well, for decades, the entire social media business model has been shielded by Section 230 of the Communications Decency Act.
Right, which basically says a platform isn't legally liable for the content its users post. The standard, we're just the digital town square, we don't control the people shouting in it defense.
Exactly. But the plaintiff's attorneys completely bypassed Section 230.
Wait, how did they do that?
They didn't argue about the content at all. They argued product liability.
Oh, wow.
Yeah. They convinced the jury that the specific design architecture of the apps, the infinite scroll, the algorithmic dopamine loops, the timed push notifications, are defective products.
So they treated the Instagram app the exact same way a lawyer would treat a physical car with faulty brakes.
That is the exact legal parallel.
But how does that actually work? A car with faulty brakes has a physical manufacturing error. How do you prove a push notification is defective?
By proving design, intent, and foreseeable harm.
Interesting.
The lawyers argued that the product was engineered to bypass user autonomy, specifically in developing adolescent brains, to maximize screen time at the cost of the user's safety.
And the jury bought it.
The jury agreed. They found the companies acted with malice and fraud.
Wow.
That single ruling implies that the core engagement mechanism of social media is fundamentally illegal under product liability law.
And that is why $100 billion evaporated from Meta's market cap in a single day.
Overnight. Just gone.
So what does this mean for I think there are like 2,300 other pending cases.
Yeah.
Are we looking at the forced end of the engagement-driven business model?
It forces a massive structural pivot. If other jurisdictions adopt this defective product precedent, platforms will have to strip out the infinite scroll and the algorithmic dopamine hits.
But those are the exact features that keep users on the screen to view ads.
Precisely. It destroys their core revenue metric.
Unbelievable.
And the cracks in the Magnificent Seven aren't isolated to Meta. Microsoft just posted a staggering 24% drop for Q1.
24%.
Yeah, it's shaping up to be their worst quarter since the 2008 financial crisis.
But, not all tech is bleeding. Let's look at Apple, sitting at $252.90.
Apple is a fascinating case right now.
They just made an AI pivot that completely shocked the industry. And frankly, I'm struggling to understand the logic here.
That's a bold move.
For iOS 27, they announced they are opening up Siri to integrate directly with rival AI assistants, specifically Google Gemini and Anthropic's Claude.
What's fascinating here is that it is a massive shift in strategy.
But Apple has spent a decade building a walled garden. Their entire brand identity is privacy and ecosystem control.
Yep.
Handing the keys of their AI interface over to Google sounds like a massive surrender. Why would they give up that control?
Because Apple is recognizing a harsh reality. They are pivoting from trying to be the best AI developer to becoming the indispensable AI platform.
Platform versus developer.
Right. Building and training these massive frontier models requires insane capital and, as we discussed, huge energy resources.
Right, the energy shock.
By integrating third-party models into Siri, they immediately catch up in capability without the massive R&D burn.
Okay, but how does that make the money if I'm using a Google product on an iPhone?
Through the toll booth model.
The toll booth model.
Yeah, it expands their high-margin services revenue. When a user queries Gemini through Siri and perhaps upgrades to a premium Gemini tier via the App Store infrastructure, Apple takes a cut.
Oh, that makes total sense.
Plus, structurally, it's a brilliant regulatory defense.
Ah, because the European Union has been hammering them on antitrust grounds.
Exactly. By proving their ecosystem is open to competitors like Anthropic and Google, they bypass massive regulatory pressure.
Very smart.
Couple that with their new pledge to invest $400 million in U.S. manufacturing partners, which acts as a structural hedge against geopolitical supply chain risks in China, and you have a very resilient corporate strategy.
It's a masterclass in shifting the narrative. But outside of Apple, the broader equity rotation is just brutal.
It's ugly out there.
Let's look at the consumer sector. Carnival Cruise Line just had to slash its profit outlook. Why? Because you can't sail massive floating cities without massive amounts of fuel, and the input costs are destroying their margins.
Contrast that with the winners in the S&P 500 this week.
Who are the winners?
Energy, a utility company, is up 6.82%. Campbell's Soup is up almost 5%. Halliburton, the oilfield services giant, is up 4.2%.
Soup, electricity, and oil. It really doesn't get more defensive than that.
When institutional capital realizes that growth multiples are vulnerable to 4.2% inflation and stagnant GDP, they don't just hold cash.
What do?
They rotate heavily into consumer staples and energy producers. No matter how bad the stagflation gets, consumers will still buy basic groceries and pay to keep their lights on. It's a textbook 2022-style flight to safety.
Okay, let's talk about where the real massive capital flows are going.
Yeah.
Because when equities become a minefield and the S&P 500 has its longest losing streak since 2022, institutional money has to land somewhere.
The flight to cash.
Right. Let's look at the bond market because the speed of the moves here is terrifying. The 2-year Treasury yield just shot up to 4.0%.
That is a massive move.
It's a straight line 60 basis point jump since the Middle East conflict escalated.
And the 10-year yield hit 4.47%, which immediately dragged the 30-year fixed mortgage rate up to a fresh 7-month high.
Ouch.
But the yield spike is just a symptom. The underlying disease is what we are seeing in the Treasury auction mechanics.
Walk us through the plumbing of that. Why are we seeing such soft demand at U.S. Treasury auctions right now?
Well, when the U.S. government needs to fund its deficit, it auctions off bonds. Usually, there's robust domestic and international demand.
Right. Everyone wants U.S. debt.
But right now, domestic buyers are demanding much higher yields to compensate for the OECD's 4.2% inflation projection.
Makes sense. You need a return that beats inflation.
Exactly. So the primary force keeping the system afloat and preventing a total failed auction is foreign capital, specifically Japan.
Oh, Japan.
They just made massive purchases, bringing their foreign holdings of U.S. treasuries to $9.3 trillion.
But what happens if that foreign appetite wanes? Like, if Japan decides to stop buying, doesn't the Fed just step in as the buyer of last resort?
Not if the Fed is fighting inflation.
Ah, because of the money supply.
Right. If the Fed prints money to buy those bonds, they inject liquidity into the system, which spikes inflation even further.
So they're trapped.
They are. If foreign buyers strike, the U.S. Treasury has to offer aggressively higher yields to attract capital, which means borrowing costs for every single American business and consumer skyrocket.
And speaking of skyrocketing costs, let's run the numbers on the commodity shocks that are driving this bond market panic.
The numbers are staggering.
Brent crude is trading near $116 a barrel. West Texas Intermediate surged past 94, pushing toward 100. And we mentioned this in the hook. Fertilizer is up 89%, hitting $660 a short ton.
If we connect this to the bigger picture, the fertilizer metric is critical because of the lag effect.
What do you mean by lag effect?
Fertilizer is a highly energy-intensive product to manufacture. When the price of natural gas and oil spikes, fertilizer spikes.
Right.
And that 89% increase will bleed into the agricultural supply chain over the next 6 to 8 months. It means your grocery bill is going to reflect this week's geopolitical shock well into 2027.
That is terrifying. But here's the piece of the commodity puzzle that makes zero sense to me. We are talking about historic, sticky inflation and massive geopolitical fear. Why aren't precious metals catching a safe haven bid?
It's a great question.
Silver dropped under $68 an ounce, and palladium fell over 5.7%. If inflation is raging, why is silver crashing?
It's all about liquidity. When institutional panic hits a certain threshold across the broader market, funds get hit with margin calls.
Ah, margin calls.
Yeah. To cover those margin calls, they have to sell whatever is liquid. They don't sell their losers, they sell their liquid
Like
winners.
whatever they can get cash for.
Exactly. It doesn't matter if it's an Apple share or a silver contract. They
Yeah.
just need US dollars immediately.
A liquidity crunch.
Mm.
Which perfectly transitions us to the chaos in the crypto market. The Fear and Greed Index for crypto is currently sitting at 10 out of 100. Extreme fear.
People are definitely freaking out.
Bitcoin dropped 5% right after the Fed meeting, testing bedrock support at $70,000. And we saw a massive $708 million flood out of the U.S. spot Bitcoin ETFs in a single day.
This raises an important question, right?
Yeah.
Is this a structural failure of crypto, or is it just institutions de-risking their highest beta assets ahead of the PCE inflation print?
I think the sources give us the answer, and it's a surprising twist. Because while the spot prices are bleeding out in the open, the actual underlying plumbing of institutional adoption is taking a historic leap forward.
It really is.
Fannie Mae, the government-sponsored enterprise that effectively underwrites the U.S. housing market, just announced they're accepting crypto-backed mortgages for the very first time.
The dichotomy between spot prices bleeding and structural integration advancing is just fascinating.
Let me make sure I understand the mechanics of this. It's like looking at a casino. The day traders at the blackjack tables were losing their shirts, panicking, and cashing out their chips. That's the ETF outflows. But meanwhile, Fannie Mae just quietly walked in and bought the actual casino building.
That is an excellent way to frame it. The spot price volatility is the gambling. The mortgage integration is the real estate.
So how does the mortgage part actually work?
Mechanically, a crypto-backed mortgage allows a buyer to pledge their digital assets, like Bitcoin, as collateral for a fiat loan to buy a house, without having to sell the crypto and trigger a massive capital gains tax event.
But wait, if Bitcoin drops 5% in a day, how does Fannie Mae manage the risk? Do you get a margin call on your physical house?
No, they manage it through massive over-collateralization and smart contracts.
Okay.
You might have to pledge $1 million in Bitcoin to get a $500,000 mortgage. If the value of the collateral drops below a certain algorithmic threshold, the contract automatically liquidates a portion of the crypto to cover the loan-to-value ratio.
Ah, I see.
Your house is safe, but your digital collateral gets trimmed. The fact that a bedrock institution like Fannie Mae has built the infrastructure to handle that volatility essentially legitimizes the asset class at the deepest level of the American economy.
So the daily price action is irrelevant compared to the long-term structural integration.
Precisely. Navigating a market like this requires ignoring the headline noise and focusing on the underlying plumbing.
Which brings us to a final, lingering thought for you to explore on your own based on today's sources. We just saw AI companies like Meta get slammed in court for their algorithms, and we are facing a massive global energy shortage.
The two biggest themes of the week.
Right. As AI requires exponentially more electricity to run these new models, how will the tech sector survive an era where their primary resource energy is being choked off by a geopolitical war in the Middle East?
It's a huge question.
Will the energy crisis ultimately be what regulates AI?
Before we wrap up, a very short, clear disclaimer. The information discussed today is for educational purposes only. Markets are highly volatile, and the geopolitical landscape is shifting daily. Always do your own research and consult a financial advisor before making any investment decisions.
Thank you for joining us on this deep dive. You are now armed with the knowledge to navigate the week ahead. Remember, the runway might be slick with crude oil, and we might be pulling up back into the clouds. But as long as you watch the instruments, you can weather the turbulence. See you next time.